Chapter 4, the accounting cycle. So this chapter is drilling down in a little more details of accruals and deferrals. It doesn't leave off when I go to full screen. This entire chapter is talking about that fourth step of the accounting cycle, end of period adjustments. I'm going to breeze through these a little bit faster. Just kind of point out some things, but you could definitely read more. Some of this stuff we've somewhat talked about, and then also I'm wanting to leave plenty of time to go through the example for your comprehensive problem. Most adjusting entries fall in these four categories. Converting assets to expenses, the prepaid insurance is an example of that. Converting liabilities to revenue. That's an interesting one to grasp. Think of an example. It's unearned revenue. So unearned revenue is the liability. That's confusing, but it is a liability. Unearned revenue. Liability account.
So would that be if, like, you're the insurance company and you receive the payment for a year's worth of insurance?
Yeah, I guess on that side, yeah, flipping that side, the other example around. I didn't think about that. That is a good example. So let's take that example. You're doing the books from the perspective of the insurance company, not from the perspective of the business that bought insurance. In that case, let's say the example here is you receive $2,400 of cash, and right now, a month has not accrued yet, so you would record this $2,400 not to your revenue at this point. You record it to unearned revenue, which is a liability account. That's confusing to understand, but from the perspective of the insurance company that is given the insurance, you're promising that you are, a liability is you're promising to perform a service in the future, or like you're you have an obligation to meet. And so from the insurance perspective, they have the obligation that if they're filed a claim with the insurance, they have an obligation to settle that insurance claim. And you accrue that monthly. So in this case, since that's a liability account, the way you increase a liability account, would you debit or credit? Credit, yeah. So 2,400. So then, let's say 1 month you're closing the books for the first month, and you need to perform this adjusting entry to convert this liability into revenue. So 1 month of this insurance revenue, that's what this, it's this revenue from the perspective of the insurance. 1 month is, was that $200? Easier math, I think, than the other one. So $200, you would perform that adjusting entry. So you would, to increase revenue, would you credit or debit 200? for this 1 month of revenue. So if you're looking at your cheat sheet, you would credit. And the reason why is a revenue is related to retained earnings. Like really, in the real way it happens is you don't just perform it's when you're closing the books, like you're closing the net profit or net loss to retained earnings. But if you're applying this to your cheat sheet, revenue affects retained earnings. To increase so since revenue increases or decreases retained earnings, if you're increasing retained earnings, do you debit or credit to increase retained earnings? And to increase retained earnings, you credit. So that's why 200 to revenue. And then you decrease the unearned revenue liability account. So to decrease a liability account, would you debit or credit?
Debit.
Yeah. And then if you're just trying to get your debits to equal the credits, another way is like, okay, well, I know I credited revenue, I know I have to debit something. So unearned liability.
And then you don't have to in the cash one.
You don't do you recorded the cash because you received the cash up front.
Yeah.
That's the whole reason why we're having to do this adjusting entry in the first place, is because we received the cash up front for revenue that was not earned yet.
So you would just simply go from earned income to earned income or revenue?
Yeah. Are you talking about to record the revenue?
Yeah.
Yeah. Yeah. So to record the revenue for 1 month. In this example, we're recording revenue for 1 month.
Yep.
So you decrease unearned revenue. Yeah. That's one way to say it. Going from you're taking off of unearned revenue account and putting it into the revenue account.
Because it's already, on the other side, it's already in the cash account.
Yeah.
So
You're not gonna.
yeah. You're just turning a liability into a.
Exactly. Number 2, that's what you're doing there in this adjusting entry. You're converting this liability into revenue.
Or owner's equity.
Well, which would then affect, when you're then closing out the books, it would then flow to the retained earnings, which is in the owner's equity account.
Would there ever be an instance where you did the full 2,400 instead of breaking it down into monthly like you did with the 200? Like
Yeah, like it's an example that this insurance example is not a good example, but the main example on that is it's just a simple, like in a CPA business, like you perform the service and they just pay you like immediately.
Yeah.
That's when you record. Instead of recording, in that example, you don't record the accounts receivable, you just code it straight to cash. Okay, number 3, another category for these adjusting entries is accruing unpaid expenses. Okay, yeah, that and uncollected revenue. So the uncollected revenue, that's the accounts receivable examples. That's what it's talking about. And so yeah, that's when you're debiting accounts receivable, crediting revenue. Unpaid expenses, I don't think we've talked about that one. An example of that one, let's see if I even have one here. Think of accounts payable. I know that. So think of accounts payable for these unpaid expenses. And yeah, okay. So let's say you're at the year end, you're closing the books for the year end. You get a utility bill. You get a utility bill January 15th of the following year. Okay? The service period for that utility bill, it covered the month of December, right? But you didn't get that bill until like the next year. Are you guys following me? You have not paid the bill yet, but you need to record that expense for the electricity, for that utility, because the service the service period for that electricity was December, which you need to. So in that case, in that example, you would credit accounts payable for $1,000, assuming the bill was $1,000, and then you would debit utility expense by $1,000. Okay, that's and the date you put on that would be 12/31 in whatever year you're closing. Okay. So then what do once you get the bill and you once you pay the bill? So what would that journal entry be?
Cash.
Yeah, you credit cash for $1,000. Like you said, you paid it on January 15th of the next year. And then you debit accounts payable on January 15th of the next year. That's an example of accruing an unpaid expense. Why is that important? Like what if you didn't record that expense in the books for that year? Why would that be important to an investor or someone reading the financial statement?
Because when they're looking at end of year profits, it'd be $1,000 off.
Exactly. Yeah. And so think of all the different bills that you might not have recorded, or things that if you didn't go through that process of this adjusting entry process and thinking through those different adjusting entries for this category of unpaid expenses. $1,000 might not seem that big for one transaction, but think of a company that probably has a lot of these bills or circumstances. It could start to add up and misrepresent the profit and overstate the profit.
So the unearned income, again, it would come in. I'm trying to follow through. So it would come in. You debit cash and credit unearned income. That's the first deal.
Yeah.
And then at the end of the month, let's say you realized half of it.
Yeah.
Would you credit unearned income?
You
And
debit.
Then
You debit.
Debit earned income. And then credit revenue or income from services.
Yeah, whatever account. Yeah. And this right here, this put B, but B represents the adjusting entry. AJE, adjusting journal entry. And that's you're doing these adjusting journal entries like it's the fourth step in the accounting process. So this 2400A would just be a step one, which is record transaction or journal entry. Okay, let's move on. Okay, depreciation. Maybe meditate on that slide a little bit later this week. we're gonna do an example of depreciation that I think will be helpful too. This is another slide on understanding like this adjusting entry, the fourth step of the accounting cycle. Adjusting entries are needed whenever revenue expenses affect more than one accounting period.
So that would be talking about the December to January thing.
Yep. Yep. That's one example. Or the other example is this depreciation where like you're buying the equipment and you depreciate, you expense it through depreciation over the useful life, like equipment like 7 years. Every adjusting entry involves a change in either the revenue or expense or an asset and liability. Yeah, here's an example of the depreciation. Overnight Auto purchased the building, $36,000. Useful life 240 months. So you're calculating the monthly depreciation, taking the cost divided by useful life of 240, you get the 150 per month. And here is the journal entry. You debit depreciation expense, and then you credit accumulated depreciation. Yeah, so it's a fun one to explain, accumulated depreciation. It's called a contra asset account. Any idea what contra means? Yeah. So contra is it's the opposite of the way that you're thinking of the normal activity of an asset. So the normal increase for an asset is what? Debit. So since accumulated depreciation is a contra asset, the normal way to increase that is a credit. Okay. Let's see.
What if you write it off like halfway through? You just take that straight to.
Write off the equipment?
Yeah, like before it's fully depreciated.
Yeah, like you sell it?
Yeah.
Yeah, we could go through that real quick. So in this example, they say they buy it by cash. Let's just assume they bought it by cash. Cash, equipment, 36,000, debit, 36,000, cash, credit. Depreciation expense. And then accumulated depreciation for the equipment. So the expense you debit 150 mainly because expense the way it eventually affects retained earnings, it decreases retained earnings. The way you decrease retained earnings is to debit. So that's one way to get to understand that. Expense, and then credit, you're not crediting the equipment asset, you're crediting the equipment accumulated depreciation. It's a way it flows to the balance sheet for formatting purposes because people want to see like the amount hitting accumulated, like depreciation. So the credit is 150 accumulated depreciation. So yeah, the way now let's just do a balance sheet. Actually, you're going to see that. You'll see in the balance sheet. I got to move on. But like if you're listing out the balance sheet, you list out equipment and then accumulated depreciation. Accumulated depreciation be like in parentheses because you're subtracting, you're netting this out. So the net equipment would be 35. What is that? 35,850 after you net out. So that's the net value of equipment after the accumulated depreciation. There's plenty of examples on balance sheets in your textbook. So that's depreciation, converting assets to expenses. We've already talked about that with that prepaid insurance. This is just kind of another way to view it. I would do it. It's just some extra information. I think if next week or this week, if you want to learn more about that, I don't think we have time to go through that now. This is also an example of insurance policy for prepaid insurance, and we've already had an example on that, but this is a slide. See, unexpired insurance. Is that what type of account is unexpired insurance in this case? Asset. I used a different term. I used a different word called prepaid assets. It's the same thing. Prepaid asset. And then cash, that's an asset. So this example was we purchased a 1-year insurance policy. But this is the adjusting entry to expense 1 month worth of insurance. So you debit insurance expense and credit unexpired insurance asset account by $1,500. This is a slide to help you analyze how that journal entry for the prepaid insurance or unexpired insurance and also the adjusting entry for insurance expense affects the balance sheet and the income statement. And so you see that it's just analyzing. So on March 1st, you paid $18,000 and increased the insurance, so it increased your balance sheet by $18,000. But then on at the end of the month, you did your adjusting journal entry for $1,500. You credit the unexpired insurance asset account. So this balance, your net debit balance, is now $16,500. And then the income statement, the only thing that has affected the income statement at this point is just $1,500 expense when you did the adjusting journal entry for insurance expense. Converting liabilities to revenue. That's when we're talking about the flip side of like the perspective of the insurance company collecting cash and the unearned revenue. That's what this slide is talking about, converting liabilities to revenue. You have your prior period, you have the transaction that you collected the cash in advance of earning the revenue. And then the adjusting entry is recognizing the portion of earned revenue, and then it reduces the liability, unearned revenue account. This is an example of rental revenue. This is an example of unearned revenue. Another example of this unearned revenue. You had a 3,000 rental contract of I didn't say necessarily what type of rental. So basically, there's some businesses out there that like rent equipment out. Like you can, in this case, it's you're renting out a tractor, I guess, for 3 months, and you get $3,000 up front, you know, this on December 1st, overnight received 3,000 in advance for the rental. So this is that initial journal entry to record it. 3,000 cash, 3,000 credit to the unearned rent revenue. This unearned rent revenue is what type of account?
Unearned income.
Yep, which is what type of, look at the red arrow. Look at that. Yeah. And go up to the right here, liability. I guess it's on the slide. The answer is there. All right, so then this adjusting entry to record 1 month of revenue, you debit unearned rent revenue, which is a what type of account? You just said it, liability, and then rental revenue you credit, and that adjusting entry is recording the earned revenue for that 3-month rental contract. Here's how this example affects the balance sheet. 12/1, you increased the liability by 3,000. 12/31, you recorded the revenue, so it decreased the liability. So you got a balance of 2,000 at the end of that first month. The income statement, you affected the income statement when you did the adjusting journal entry to record the revenue for 1,000. That's Chapter 4. Chapter 5, the accounting cycle, reporting. Yeah, so now we're like, we've talked thus far about just getting transactions into the system, either through a journal entry transaction or doing these adjusting journal entries. Now, Chapter 5 is talking about, okay, once you have all the journal entries in, now what do you do with all of that? This is talking about reporting these financial results. And also just the different things that go on to reporting requirements. Publicly owned companies share, those are the, we're talking about once again, we're talking about corporations. And so in this class, so from the corporation standpoint, it's you're dealing with stock. So you issue stock. So basically you buy, just like you and me, we could go buy stock of Facebook or these publicly traded companies. Publicly owned companies. So a publicly owned company, it is what it is. It is exactly what it's saying. It's a company owned by the public. So obviously a lot of these big companies like Facebook, they'll have, one major investor, but then also they have a lot of, thousands upon thousands of other investors that own a stake or a share of the stock of like Facebook. So a publicly owned company also have an obligation to the public to publish quarterly and annual filings. And they had to undergo annual audit by auditing firm registered with the Public Company Accounting, I don't know, I forgot what O stands for, board operating, I can't remember what, but anyway, it's a governing agency that oversees, they have oversight on making sure that they're reporting these financial statements accurately. They have to file audited financial statements. So public companies have to have a firm, an auditing third-party external firm audit their financial statements. And then also the Security Exchange Commission, SEC, also has some extra schedules that they have to report to the Security Exchange Commission. The accounting cycle summary. This is just another slide of summarizing the accounting cycle. an adjusted trial balance. So what this is describing is the balances after you've performed all your adjusting journal entries. Then you have balances in all of these accounts, and it's called the adjusting trial balance. You take all those balances of all these asset, liability, owner equity, and revenue and expense accounts, and then you take those balances and accounts to prepare these three financial statements: an income statement, statement of retained earnings, and a balance sheet. Key point: they're not including the statement of cash flow. Oh, looks like, yeah, it's just saying that this chapter is not talking about the statement of cash flow in detail. These are the three statements talking in detail in this chapter. This is an example of an adjusted trial balance. You could notice it starts with the assets, cash, goes to the liability starting at note payable, then the equity starts at the capital stock, and then the income statement items start right after dividends, the repair service revenue, and then it lists out expenses. That's the general format. So yeah, going back to kind of your question on formatting, if it's like a comprehensive homework problem, follow this formatting. But I have helped you out because I've given you a template. But yeah, that is like a standard that by industry standard they format the assets, then the liabilities, then the equity, then revenue, then expenses. Income statement. This is when you're preparing these three separate statements, you always start with the income statement because you're going to use information off of that income statement, mainly the profit. That remember that is the number you're going to then report as retained earnings on the balance sheet. So you got to know what your profit or loss is to know what to put to either increase or decrease your retained earnings. So you always start with the income statement. Other titles for an income statement: earnings statement, statement of operations, profit and loss statement. Some limitations of the income statement, accounting estimates, some assumptions. This is an example. If you notice on the title, it says for the year ended December 31st, 2018. So are those numbers, how many months worth are in these numbers, assuming it's a calendar year end company, according to that title? 12. So for the year ended December 31st, those numbers are 12 months worth of activity. Statement of retained earnings. It's detailing the portion of the stockholder equity. It's just giving you detail of how the equity section of the balance sheet either increased or decreased. You increase it by going to here 2A by net income increases retained earnings. The decrease is net loss, like losses, or dividends will also decrease. Dividends the trick on dividends that some people get hung up on is sometimes they think it's an expense account. It's not. It's an equity. It goes on the dividends is not an expense account. It doesn't go on the income statement. Dividends, it's in the equity section of the balance sheet. So therefore, if you pay out dividends to your stockholders, your
Equity will go down.
equity going down. So that means if equity is going down, your debit dividends. Computing retained earnings. You take the beginning balance of your retained earnings, add net income, or you would subtract net loss, and then you subtract out any dividends, and that equals your retained earnings at the end of the period. This is an example. What is this? Dividends to stockholders are not considered. It's a slide what I just said about dividends not being an expense.
So they're not an expense.
Not an expense.
So how do you they're an equity item?
Exactly. Yeah. It's an equity item. So in this example,
Doesn't it depend on the type of corporation though? Like, because if it's not an expense, it would be taxable like on a C Corp, and on an S Corp, it wouldn't be taxable, right?
yeah, so you're getting into the perspective of the stockholder, I think. Yeah.
I'm just saying, like,
Yeah. But yeah.
you gotta figure out, like, I'll give you an example, like on this week's homework, it's asking for, like, you to figure out income tax. One of the questions, so, and there's a dividend, like, if a dividend's paid, would that be taxable or not, part of that taxable or non-taxable?
Dividend would not, because you're thinking from the perspective of the C corporation.
Yeah.
Dividend would not reduce
The tax.
the tax burden from the now. Like if we're taking a tax class, then like if you're taking from this perspective of the stockholder, that dividend you received, you pay tax on it. So then yeah, like I'm getting way.
Well, I'm kind of thinking because the next week's homework.
Yeah.
Part of
For that, just know that dividend is not an expense, so therefore it would not reduce your tax burden. Remember that. Yeah. This example is earnings, credit. Example of closing the dividend. Let's read this out. So dividend is not, okay, we are talked about that. So you understand, and everyone understand dividend is not an expense. So it does not reduce your tax burden from a corporation standpoint. So therefore, they are not taken into account in determining net income for the period, which, would affect your tax calculation. Since dividends are not expense, the dividend account is not closed to income summary account. Instead, it's closed directly to the retained earnings account. So that's kind of detailed. I'm not even sure if that's on. I don't think that's even on the quiz. That's a pretty detailed slide. What that is saying is so you pay a dividend, credit cash, debit dividend, but then there's a lot. Then you close the dividend account to retained earnings. So you would then credit. What this is saying, you credit the dividend and then you debit the retained earnings. That's what it's trying to say. Because like when you're going to it's because because you're reporting on the balance sheet, you're seeing one line item for retained earnings. Dividend is like a sub account. It's like under.
So they're showing you the progression through the.
Yeah, that's all this slide is trying to tell you. And I'm not even sure if you. I think that might just be some extra uh, uh, information for you to know about this class. I'm not sure if there's necessarily any homework points or quiz points by knowing that particular concept. Statement of retained. Yeah, this is what a statement of retained earnings would look like. You take this beginning retained earnings. I'm not real sure why it says January 20th. To be quite honest, I would think it would be January 1st. I think that's a typo, or assuming like the business started at January 20th. So don't read too much into 20. It's the beginning. This is looking at it from a year. See how it says for the year ended, assuming once again it's 12 months worth. So you're taking the beginning of the year, January, and then adding the net income and less dividends equals the ending balance of retained earnings at the end of the year. Yeah, I took these. There might be another slide that I didn't include that probably explained why I had January 20. So. Balance sheet. This lists out assets, liabilities, owner's equity, also called the stockholders' equity. We've been using the word owner equity, but since we're viewing this in this textbook as corporation, from the corporation perspective, it's really stockholders' equity because they're issuing stock to their owners. In the balance sheet may be presented with assets on the left side, liability, equity on the right side.
So the equity is not a taxable item either, right?
When you're calculating tax,
yeah,
equity is not. No, it's the income statement is where you're going to calculate the tax. Yeah. It may also be presented in report form with assets at the top and liability and equity. To be honest, I don't know what number 2 is talking about. Does anyone? I don't think that's important. I'm not sure the concept of why they put that. Like assets on the left side, liability and equity on the right. I'm like thinking of the accounting formula. Like it's on the left side, assets are on the left side of the equal sign. So don't read too much into that number 2. I'm pretty sure that you don't necessarily need to know that for a quiz. Number 3, like it's talking about the formatting of the actual report. Like you're having the, yeah, it has to be talking about the accounting formula. This has to be because the assets are on the left side of the equal sign, and then the liability and equity on the right. If you're analyzing it like from an algebra standpoint, but then this number 3 is if you're looking at the accounting formula from the format of like an actual balance sheet, your assets are always at the top, and then the liability and equity are below the assets. Just like this. Assets at the top, and then see how liabilities are at the bottom. That's all that point was trying to explain. So don't read too much into that slide. Okay, chapter 7, financial assets. Financial assets describe not just cash, but also those assets easily converted to cash. So these examples include cash, but then also short-term investments called marketable securities and receivables. Anybody, have y'all heard the term marketable securities? Like it's the same thing as like putting money, like your cash into a savings account or like a money market fund. That's what it's those you could, like, you can call your broker or your bank and cash out of those like in a day, or it might take 3 days for it to transfer to your bank account, but it's easily converted to cash. Receivables easily, supposed to be easy converted to cash. Those typically aren't, maybe 3 days. It might take 30 days to convert to cash, but it's a lot easier. You're counting on that asset to convert to cash a lot quicker, obviously, than like a piece of equipment. Financial asset valuation. Cash is just you. It's at face amount. Short-term investments, the fair market value. Receivables, the net realized value. Cash management refers to planning, controlling, accounting for cash transactions and balances. Here are these objectives of cash management. Provide accurate accounting for receipts, disbursements, and cash balances. And prevent fraud. Anticipate the need for borrowing, assure availability of adequate amount of cash. Make sure you have enough cash to conduct your operations in your business. And then also a key component of cash management is not just like putting your cash to work. You don't want you want to have enough for sure to cover your operating expenses and to conduct your business. But then at the same time, you don't want all this idle cash just sitting in the bank account. You want to put that money to work so you want to put that money into an asset or investment to produce revenue for your business. Reconciling the bank statement. That's a key component. Explains these differences between what you have in your bank account and what's in your system, or balance shown in your records. Yeah, see, it's the outstanding checks and deposits and transits. Those are the two things that main discrepancies of why your bank account in your system, accounting system, will not tie out to your bank account like on your bank statement. Very rarely does your bank account actually tie out to your system, because when you're closing the books, most businesses always have like a check that they've written that hasn't been cashed by their vendor, like an outstanding check. And so you'll always have these discrepancies. These other reconciling items, like a service charge. So sometimes you might, I don't know if you've ever opened up your bank account and seen like a bank service charge on your account. I've gotten a few of those, like actually it's these random things, like with Zelle. You ever paid people through Zelle? Heard of that service through your bank? It's like a service. It's like a way, like kind of like PayPal. You can pay people through a service, like it's kind of like a service like PayPal, if you've heard of that. But a lot of these major banks use Zelle, and I was receiving payments through Zelle, and then I open my bank account. I get charged like $15, and from the bank. And I called the bank. I was like, "Why am I getting charged?" And they were like, "Well, your type of bank account, you get charged if you receive deposits using Zelle." Well, my bank in Texas doesn't do that, you know. So like Chase, it's U.S. Bank was charging me for it. Chase Bank in Texas, and there's no Chase banks up here, or not any. I think they might have one that's far away from where I live. So anyway, yeah, when I'm reconciling my bank account to what's in my books, I'm off by $15, and sure enough, it's because of this other reconciling item, this service charge I got. They reversed it. I called them on, and they reversed it. But anyway, that's an example of a service charge, a reconciling item when I was reconciling my bank account. Other nuances of reconciling items sometimes come up with a non-sufficient fund check. Like a bank charges for depositing a check that has non-sufficient funds. So obviously that might be something you might not have recorded in your books, and you wouldn't have caught that until you reconciled your bank statement to what your accounting system had. Interest earned. So yeah, some of these checking accounts or bank accounts, like you're earning interest on the idle cash, so you might not have recorded interest that you earned on that account, and that would fall out when you're reconciling the bank account. And then miscellaneous bank charges and credits. Yeah. I got a miscellaneous charge the other day, and I called up the banker. I was like, "What is this charge?" Well, you viewed too many images of checks you deposited, and so since you only allowed to view 10 a month, and you viewed more than 10. I was like, okay, I didn't know that when I signed up. And yeah, they reversed the charge, but it was just really annoying. You know, it's like, I'm like, once again, reconciling my bank account, and then it was $12. That was an example of a miscellaneous bank charge that I didn't know about unless I was actually reconciling my bank account. So, U.S. Bank, a very good bank. I don't want to rat them out, but I don't know. Just some differences from my other bank in Texas. Looks like that's the end of the slides. We're on track though. It looks like. Let's take a break. I need to fill up some water, and then after that, I'll give you some other tips for the quiz. That aren't on the slides that you kind of only get if you just show up to class. So, and then we'll go through an example for the comprehensive problem, and that's only 2 things we have left. So let's take a break and let's just go take a quick water break, like no longer than 5 minutes or so.